Walk into any modern Chinese city, and the air is constantly filled with two highly addictive robotic audio chimes, Alipay received and WeChat Pay. If you insist on pulling out a physical wallet and fumbling for spare change at a checkout counter, people won't think you're wealthy, they'll think you're a time traveller. Whether you're buying a luxury handbag at a high-end boutique or a 5 RMB greasy street-side breakfast, your entire financial life is ruled by a dirt-cheap black and white grid, the QR code. For first-time foreign tourists, this creates a bizarre new form of paralysis. It's not that you don't have money, it's that your money is, inconveniently, physical. Today, China is globally recognized as the largest and most advanced digital payment ecosystem on Earth. According to the latest central bank data from the first quarter of 2026, this colossal non-bank network processed over 304 billion transactions in just 3 months. To put that into perspective, in the blink of an eye, this giant machine is processing a staggering 39,000 digital clicks every single second. Within this infrastructure, mobile payment has achieved a sweeping 92.3% penetration rate among consumers. It's an absolute digital duopoly, where two leviathans, WeChat Pay and Alipay, collectively swallow up 87.5% of the market. This effectively traps nearly all daily commerce within the glowing confines of a smartphone screen. Economists call this leapfrogging. This is a phenomenon where a developing nation completely skips an entire generation of technology that the West spent half a century refining. By bypassing paper checks and credit cards, they jump straight to the ultimate solution. But to understand how this cashless empire was built, we can't just look at the rise of tech monopolies. We have to wind the clock back to the year 2000, to a pure cash era when wages and prices looked radically different. Western audiences might find one fact baffling. Why does the world's second largest economy cap its largest physical banknote at just 100 renminbi, worth a measly $14? In the early 2000s, this wasn't a flaw, it was a feature. According to China's National Bureau of Statistics, the average monthly wage of a Chinese worker in the year 2000 was only about 800 RMB. In an era of rock-bottom prices, a single 100 renminbi was a massive sum of money. This meant ordinary citizens had zero reason and zero opportunity to ever use anything larger. Think about it. If the central bank had issued a 500 or 1000 RMB note back then, a single bill would have exceeded a worker's entire monthly income. Carrying a 1000 RMB note would feel less like having pocket money and more like carrying a live grenade. If you lost it, you didn't just lose some cash. You lost the literal soul of a month's worth of relentless overtime. And if you tried to use it to buy a 0.5 RMB popsicle on the street corner, it would be the economic equivalent of driving a heavy-duty semi-truck into a farmer's market just to buy a single cabbage. Even if the vendor sold you their entire stall, they couldn't give you change. The grassroots economy simply lacked the infrastructure for large denomination transactions. So, the decision not to print larger bills wasn't just because people didn't need them. It was a masterstroke of physical financial defense. First, it capped the blast radius of counterfeit cash. Back when security features were primitive, receiving a single fake high-value bill could wipe out half a month's grocery budget for a poor family, a catastrophic loss. Second, it imposed a massive physical tax on the underground economy. In the West, money laundering relies on complex offshore accounts and shell companies. In early 2000s China, corruption was old school. It required physical stacking. Keeping the maximum denomination at 100 RMB meant that if you wanted to pull off a massive illegal transaction or hide bribes, you needed full rolling suitcases or an entire spare bedroom just to stack the paper. This high volume cost made financial crime incredibly conspicuous. But then came the tipping point. Following China's entry into the WTO in late 2001, the economy experienced one of the most explosive booms in human history by the 2010s. People suddenly had disposable income. They wanted air conditioners, TVs, cars and apartments. Yet, with the largest banknote rigidly locked at 100 renminbi, a massive supply and demand black hole ripped open in China's financial infrastructure. To bridge this gap, China began scaling its own bank card network, now famously known as UnionPay. This created a bizarre dual-track economy. People would swipe UnionPay cards at high-end department stores for major purchases, but the moment they stepped back into daily neighborhood life, they had to revert entirely to cash. Why did credit cards fail to capture the pockets of Chinese consumers the way they did in the West? It boiled down to a brutal economic calculation: the merchant's math. Card adoption relies heavily on POS hardware terminals. But expanding that infrastructure hit a wall that the West still struggles with today. For a Western merchant, accepting Visa or MasterCard means bleeding out a 1.5% to 3.5% transaction fee to the banks. But for a local Chinese street vendor selling savoury crepes or breakfast snacks, a traditional bank POS terminal wasn't technological progress. It felt like state-sanctioned highway robbery. They had to pay hundreds of yuan up front for the hardware, run a dedicated telephone line to the stall, and worst of all, let banks shave off a massive chunk of their razor-thin profit margins. The Western financial blueprint suffered a severe tissue rejection when applied to China's massive, hyper-cost-sensitive grassroots market. Street vendors preferred counting sticky coins until their fingerprints wore off rather than installing a POS machine. Combined with a lack of established consumer credit histories and a culturally conservative aversion to debt, the traditional credit card dead-ended at the grassroots. And against this backdrop, the stage was quietly being set for a seismic shift. Enter the internet and the dawn of smartphones. In the early 2000s, online shopping in China was an elite, friction-heavy sport. PCs were expensive, and early online banking software required the technical patience of an IT specialist. When tech entrepreneur Jack Ma launched Taobao, the e-commerce model hit a wall of cultural distrust across China's vast geography. Buyers were terrified that if they wired money, the seller would vanish into thin air. Sellers feared that if they shipped goods, the buyer would simply ghost them. It was a classic digital standoff. To shatter this deadlock, Alipay was born, introducing an ingenious escrow system. Alipay stepped in as a neutral, absolute referee. Buyer, give me the money first. I'll lock it in a safe. Seller, now that the money is secured, ship the goods. Buyer, once you unpack it and swipe your approval, I'll unlock the safe and pay the seller. Through a centralized system, technology forcefully fabricated a social credit framework out of thin air, allowing millions to trade with complete peace of mind. After 2010, smartphones has started to rise, and occupying the internet culture in China, Tencent developed WeChat in 2011 for a messaging and social media app. That is, until the Lunar New Year of 2014, when it dropped a tactical masterstroke: the digital red envelope. Gifting cash in red envelopes is a sacred Lunar New Year custom. WeChat simply digitized it. The resulting social experiment triggered an avalanche. Over the holiday, nearly 10 million users participated, furiously snatching up over 40 million digital red envelope, and Tencent engineered a flawless double bind. Do you want to flex and send packets to your friends? Too bad. You need to link your bank card to fund it. Did you win a few cents in a chat group? Too bad. You must link your real bank card to cash it out. Driven by this simple psychological loop, WeChat Pay's linked user base skyrocketed from 20 million to over 100 million in a matter of days. Jack Ma famously described this campaign as the Pearl Harbor attack of digital finance. From cynical teenagers to elderly grandparents who couldn't remember their bank pins, everyone willingly surrendered their banking info just to claim a few cents of digital holiday fortune in family group chats. Overnight, WeChat used ancient tradition to pull off a mass financial education campaign that the West has still never replicated. Following this, the ubiquitous QR codes of WeChat and Alipay emerged. slashing merchant fees to a microscopic 0.1%, or initially, absolute zero, requiring no physical hardware at all. It wasn't just a win for technology, it was a devastating, asymmetric strike against the fee-sucking apparatus of traditional banking. But there is no such thing as a free lunch. The extreme convenience of cashless transactions conceals a steep psychological toll. In behavioral economics, there's a concept known as the pain of paying. When you physically count out 10 crisp, red bills and hand them over, your brain's amygdala lights up with a response similar to physical pain you feel the loss. But when money is reduced to a fleeting string of pixels on a screen, or when payment requires nothing more than flashing a polite smile at a facial recognition camera, that pain is completely anesthetized. Spending money becomes as frictionless as clicking OK in a video game. This total sensory detachment has methodically funneled a generation of youth straight into the invisible debt traps carefully woven into these apps. Beyond psychology, this ecosystem extracts a brutal hardware tax. In China, WeChat and Alipay are no longer mere apps. They have mutated into parasitic operating systems nesting inside your phone, swallowing everything from social media, banking and e-commerce to ride-hailing and food delivery. To cram full gaming engines, micro-lending platforms and independent web browsers into their code, their cache sizes swell to monstrous proportions, casually devouring tens of gigabytes of phone storage. This indirectly forces consumers into a vicious cycle of upgrading their smartphones just to keep up with storage demands. The more ominous side effect was the inadvertent release of an unmanageable financial beast, the catastrophic collapse of China's P2P lending platforms in 2018. This crisis was the direct, systematic consequence of a hyper-cashless landscape. In the old brick-and-mortar banking era, if you wanted to dump your life savings into a suspiciously high-yield investment scheme, you had to put on shoes, walk to a branch, wait in line, and manually sign forms. That physical distance and bureaucratic friction served as a crucial, forced cooling-off period for human rationality. But once WeChat and Alipay integrated third-party shadow banking pipelines, absolute zero friction erased that final line of defense. With just 2 casual taps on a screen, a lifetime of retirement savings evaporated into speculative platforms in under 3 seconds. By 2018, ridden with fraud, lack of oversight, and classic Ponzi structures, the bubble popped. Thousands of platforms went belly up overnight, wiping out the life savings of millions. It proved a terrifying thesis. When money becomes entirely digitized, systemic financial risk amplifies at the speed of the fiber optic internet. In reality, tying a nation's entire financial livelihood to a singular social media app creates repercussions far beyond bad loans. It has seamlessly woven consumption habits, personal networks, and real-time location tracking together, sparking massive privacy and data security crises, while systematically erasing the boundary between life and work. But that is a story for another day. Looking back at this 25 years leapfrog revolution, China transformed overnight from a low-wage cash society into a hyper-efficient cashless empire. In that earlier world, a 100 RMB note was considered too large for daily use. It is, undeniably, a miracle of transaction efficiency. But when we pivot to the West, the reluctance to universally adopt QR codes isn't a symptom of technological backwardness. It is a rational choice, deeply rooted in path dependency and risk diversification. The West spent half a century building a highly mature credit card ecosystem. It offers robust legal shields like fraud zero liability and chargeback mechanisms, providing a regulatory cushion that instantaneous QR code scanning completely lacks. Furthermore, strict Western antitrust and privacy laws make it legally impossible for a single tech monopoly to blend your private conversations, retail habits, and bank credentials into one omnipotent app. The West's apparent sluggishness isn't a failure of innovation. It's a deliberate institutional check designed to safeguard individual privacy and prevent monolithic corporate autocracy. They are inherently terrified of a digital panopticon, a single app that holds hostage your friendships, wallet, transit history, credit rating, and diet. Perhaps humanity has never found a flawless equilibrium between hyper-efficiency and absolute individual security. Different cultures simply choose different trade-offs based on their historical realities. The next time you pull out a physical piece of plastic at a Western grocery store, it might feel a little less cyberpunk than scanning a pixelated matrix. But maybe, just maybe, that minor friction is the literal insurance premium we pay to prevent ourselves from sliding into a totalizing digital regime. It leaves us with one final question. How much of your digital soul are you willing to trade for the convenience of leaving your wallet at home? And as we chase absolute efficiency, how do we defend our final personal borders? There are no easy answers. Let us know your thoughts in the comments below. We'll see you in the next deep dive. Thanks for watching.